What is quantitative easing and how does it impact my portfolio? Have you ever wondered how the decisions made by the Federal Reserve can affect your retirement savings? One key tool they use is called quantitative easing. This monetary policy involves the central bank purchasing large amounts of government bonds or other financial assets. The main goal is to inject money into the economy, especially when traditional interest rate cuts are not enough to stimulate growth. So, how does this relate to your portfolio? First, let's talk about interest rates. When the Federal Reserve engages in quantitative easing, it pushes down yields on government bonds and other fixed-income securities. For retirees or those nearing retirement, this means that safe investments, like government bonds, provide lower income than they used to. This can be a challenge because many retirees depend on these income streams to cover their living expenses. Next, let's look at asset prices. By increasing demand for bonds, quantitative easing encourages investors to seek higher returns in riskier assets like stocks and corporate bonds. This often raises the prices of these assets, which can benefit retirement portfolios that hold equities or diversified funds. In the short term, this can increase the value of your investments. Now, consider the impact on pension funds and retirement savings. Pension funds typically hold large amounts of government bonds. When yields drop due to quantitative easing, it increases the present value of their future liabilities, meaning the pension payments they must make become more expensive. While asset prices may rise, the cost of meeting these obligations can create funding challenges. For individuals, this could lead to changes in pension benefits or increased pressure on public pension systems. There are also risks to think about. The low-yield environment means retirees might need to take on more investment risk to achieve the income they desire. This could lead to increased volatility in their portfolios. Additionally, quantitative easing can contribute to asset bubbles, making markets more vulnerable to sharp corrections that could negatively affect retirement savings. For younger workers saving for retirement, the situation is also concerning. If quantitative easing policies continue, they might face lower returns over their careers, which could impact the growth of their retirement funds. Looking ahead, while quantitative easing can boost economic activity and asset prices in the short term, its effects on retirement portfolios depend on how interest rates change afterward. If rates stay low for a long time, retirees may struggle to generate income from traditional fixed-income investments. On the flip side, if rates rise, bond prices could fall, negatively impacting portfolios. In summary, quantitative easing lowers interest rates and raises asset prices, which can temporarily boost the value of retirement portfolios. However, it also reduces income from safer investments and may increase risks. As you manage your portfolio, consider these effects and seek a balance between income needs and growth potential while being aware of the risks associated with low interest rates and market volatility.